Reserve Bank President Charles Evans said, I think anytime the economy decelerates from 3.1% down to 2%, it takes a really sharp-minded focus to kind of go, all right, it's less than what we had, but it's still pretty good. Do you agree? Is this where things stand? While they may not be great and they're certainly not as good as they were, conditions are still pretty good?
I think that is probably the prevailing thought process. Now, that drop, that's a massive drop. 3.1 to 2.0, that's a massive drop. However, what if it was 2.5 to 2.0, right? It wouldn't have been as much. So, I guess we're looking at it with the glass half full rather than the glass half empty. I don't necessarily agree, and he's obviously a lot smarter than I am, but I don't necessarily agree that 2.0 puts us in a great place. It puts us in a great place compared to the rest of the world, compared to the rest of, geoeconomics. But in terms of the long-term sustenance of our economy, the growth of our economy, that's not a great rosy number.
No, I completely agree, Scott. And I mean, if you take a look at rates, I actually have a chart here for us to pull up. Look at the 30-year and the 10-year side by side. I mean, for the most part, we've got traders, we've got investors that are expressing the same opinion that you just communicated.
Absolutely. And yeah, we've had a nice rally back in obviously in the 10-year off those lows that we saw last month down at 235 up to where we are right now. I think we're going to start to level off quite a bit here, Ben. There is some big technical resistance just up above at around 263 or 264. I don't know if we're going to hit that or not, but you know what? The reports that we're going to get later today, Redbook and industrial production, some of the housing numbers, all that's going to really start to play into it. None of those reports, none of those numbers in and of itself is a major contributor to what the Fed is looking at or what the economy is looking at. But when you start to add up all of these reports together, they're going to signal what's really ahead, along with earnings season, what's ahead for the economy here.
Yeah, Scott, you mentioned earnings season, but prior to, it seems like for the most part, the last few months at least, the last 6 months, I guess one could argue, a lot of the focus has been on U.S.-China trade talks and resolution thereof. I'm wondering if you think that's what's helped rates, well, really come off those spike lows. I mean, we've sort of become a little bit more dovish in terms of our approach towards U.S.-China trade talks, it seems like. At the very least, we've taken a little bit of a step back. I'm wondering, have cooler heads or cooler minds prevailed here, and are investors saying maybe that move that we saw to the downside was just too much too fast, and again, kind of what we were saying, things aren't as bad as we thought they were?
Well, the trade talks are obviously front and center, and they are just, holding the market at bay, if you will. But what really happened last month was quite frankly the neuroses, the panic in the marketplace over the inversion of the yield curve, which you and I had talked about several times. I thought was very much overdone. And we saw the sharp spike down again to those 10 years around 235, which, I thought was completely overblown. So I think we're where we need to be right now. We do obviously have, minute by minute, second by second, the market is waiting on any sort of tariff talk here. But I think last month that was all more of a, I don't want to say a media panic, but it was really a panic because of the inverted yield curve issue.
So, Scott, one thing that I often see in terms of price activity is when you see panic, oftentimes price reaches an upper or a lower extreme. I mean, depending on which side the panic is on. I'm wondering, if you take a look at the TNX on the daily, you can see the spike up in October last year, 3.24%. We just talked about the spike lower last month, 2.35%, with the Fed on hold and what appears to be no change in terms of policy on the horizon. Have we seen the upper and the lower extremes related to panic and some of the uncertainty? Should we look for more consolidation type pattern type activity to form here now?
Absolutely, and history always repeats itself, or tends to repeat itself, and I liken that move, Ben, to what we saw a year ago February in the marketplace, when we got that first panic in the marketplace here, when we saw the Dow drop and the market sell off violently, and we saw VIX raise up to the 50 level a year ago February. But then every time that same type of news came out, less shock to the system. And I really liken to that to what we just saw with the spike up in rates in October, and then those rates getting absolutely hammered just a month ago.
Yeah, Scott, let's talk a little bit about rates and the dollar, because while rates were coming off, or more specifically, I should say, as the TNX got down to that 2.35% level, oddly enough, it had little impact on the U.S. dollar.
Yes.
It's been inching higher, even with rates coming off recent lows. Should we expect the dollar to continue to brush off rising rates in the same way that it seemed to brush off falling rates?
Well, the tailwinds behind the dollar, Ben, is that it's best in class, right? You compare it to other currencies around the world, and it's best in class here. I really think that if we do get some resolution in the coming weeks, coming months to the tariff talk, we're going to see the dollar back off.